Today, we're talking about building your commercial real estate investment portfolio, why you should be investing in commercial real estate, strategies for approaching the investments, and how to properly scale your business. Commercial real estate is an incredible wealth builder. These properties can provide you with cash flow, appreciation, tax advantages, and other benefits unlike any other investment vehicle. If you're looking for the ultimate retirement plan, commercial real estate investments might just be the path for you and are a terrific way to diversify, if nothing else. Here's how to add commercial property to your portfolio and why you should. Commercial real estate is one of the best investments you can make. In fact, 10% of the world's billionaires built their wealth through real estate investments. So why does commercial real estate make for such a necessary addition to every investor's portfolio? Because of the stability, cash flow, appreciation, and tax advantages. Historically, commercial real estate returns sit neatly between the high volatility of stocks and the low volatility of bonds, making it a middle-of-the-road investment in terms of risk. Yes, the stock market has slightly outperformed commercial real estate historically, but it doesn't offer investors many of the same benefits. In commercial real estate, investors can receive passive income through cash flow, utilize third-party capital to acquire the investment, such as debt or leverage, write off a significant amount of tax liability, and touch and see the asset since it's tangible. So, if you're interested in those returns, buy commercial real estate. Here are my 7 steps to building that portfolio. Step number 1, choose an asset type. When you first start investing in commercial property, it's important to decide upon an asset type because there are many shiny objects in real estate. There's different property types, different investment strategies. There's almost an infinite amount of ways that you can approach this investment vehicle. However, in order to give your investment the best chance for success, it's important that you become a knowledgeable and competent investor. So find your niche. Decide which asset type you're going to focus on and invest in. There are a number of commercial real estate assets available to you as an investor. The primary commercial property types are multifamily, office, retail, industrial, and hospitality. Each of these asset types has its own pros, cons, and quirks. I recommend that you study each of them thoroughly before beginning your journey. You may just realize that another asset type is more appealing to you for the long term. Become the expert in this niche and be the most knowledgeable investor in your market for this asset type. That will certainly come in handy when other investors or brokers find an asset that fits your criteria. They'll immediately think of you. Economies of scale. One of the primary benefits of focusing on your niche are the economies of scale that come with it. If you're looking to significantly grow your portfolio of commercial real estate investments, you'll need to be able to scale and benefit from the synergy your own properties create for each other. Let's say you focus on office space. You'll be able to move office tenants between your buildings if they grow or downsize, and you'll be able to properly and efficiently manage your properties since you'll have your systems down. Not to mention that you'll become the go-to person for that investment type. Digging down and focusing on a single property type, at least when you're getting started, is the best way to start your commercial investing career. If you want to become the biggest tree in the forest, you need the strongest roots. Step number 2, choose an investment strategy. Now that you've chosen an asset type, it's time to choose your strategy. Think intently about your long-term goals and risk aversion. What you're looking to accomplish will determine which investment strategy is right for you. There are many different strategies that you can choose from, and just like choosing an asset type, it's best to niche down and stay focused. What kind of investor do you want to be? Are you looking to grow aggressively? If so, you'll be more keen to take risk. Or maybe you're just looking to conservatively build and preserve your wealth. If that's the case, you'll want something that's far more stable. The great thing about commercial real estate is that there's an investment strategy for everyone. So looking at different investment strategies. There are a number of commercial real estate investment strategies out there, and here are just a few. Land banking, which is purchasing tracts in the path of development for the appreciation. Development, taking raw land and reimagining what could exist on that property. Fix and flip, buying a property, making any repairs and upgrades, and reselling it. Wholesaling, putting a site under contract, which is often off market, and selling that contract to another investor. Owner occupied, where you purchase the real estate to operate your business out of. BRRRR, value add, which stands for buy, rehab, rent, refinance, and repeat. And we have a wonderful video on the BRRRR strategy if you're interested in taking a look at that. Long-term hold, where you purchase a property for long-term cash flow and appreciation. You have plenty of options to choose from depending on your risk tolerance and inclination to actively work on a project. If the property has a higher risk profile and needs more active attention, you'll likely experience better returns. On the flip side though, if the property has a low risk profile and requires zero oversight from the ownership, you'll find lower, albeit more stable, returns. Step number 3, explore your funding options. You don't have to pay cash when investing in commercial real estate. In fact, you don't have to come out of pocket at all if you structure the deal correctly. The first investment I ever made was a small 6,000 square foot office building about 15 minutes from downtown Nashville, and I paid zero out of pocket. How? Since I have my real estate license, I negotiated for the sellers to pay me a commission, which would be paid at closing. That amount became my initial equity contribution, and I raised the rest of the equity from 2 investors. We received a loan from a commercial lender to cover the rest, and that became my first investment. If you're interested in learning more investment strategies with little to no money down, check out this video here. Raising equity for the deal. When purchasing commercial real estate, you will need to source equity, whether you intend to utilize a commercial loan or not. Equity is simply the amount of money you receive after paying all expenses if you sold the investment. Most commercial property owners will raise 20 to 25% equity to purchase a property and finance the rest with a commercial loan. So where do you find equity? There are many different ways to find equity for your investments. You could place that capital yourself and forego bringing on partners. You could pitch the project to other investors and share the deal with them. Or, if you buy the property right, you may find equity in the property if the appraisal comes back higher than the purchase price. Any way you slice it, you will need to bring equity to the table when building your portfolio. Now let's talk about sourcing the debt from a lender. Lenders are an excellent source of capital if you're looking to grow a portfolio of commercial properties. Equity is very finite, and there are only so many properties that you can purchase before you've run yourself out of capital. That's where commercial loans come into play. You need to start building relationships with lenders far before you start searching for property. After all, they will be your money partners. They will have a vested interest in the project's success, and these lenders will often go to bat for you if you haven't yet built your track record when you're looking to secure a loan from the bank. Lenders will have varying requirements for the project in order for them to consider lending to you. These may include the debt service coverage ratio, or DSCR, which is the project cash flow to debt obligations ratio, loan to value, how much of the purchase price they'll give based on the property's value. Loan to cost, how much of the purchase price and expected renovations they'll give you based on the all-in cost. If your focus is to build a portfolio, these relationships will be crucial to your ability to scale. No cash, no deals. Now you do have other finance options. If you choose to forego the traditional commercial loan route, there are still a few paths to take. Among the most popular are hard money loans, which are private money loans with shorter terms, owner or seller financing, where the seller of the property finances your purchase, or rent to own, where the rent payments apply to the purchase price. You can also get very creative with the funding. Another one of my favorite resources for finding capital for equity is utilizing a line of credit. When you own a property and have equity built up in it, you can take out a line of credit on that property guaranteed by the equity for use as the down payment on your new investment. As long as you're willing to get creative, you can always find a way to fund the deal. Step number 4, start the search. Now that you've educated yourself on your niche, decided upon an investment strategy, and figured out how you're going to fund the project, it's time to start the search. And there's a reason I recommend you take those other 3 steps first. When you dive into the world of commercial real estate, you'll be working very closely with other commercial real estate brokers and investors. It's a very tight-knit community. You don't want to get a reputation for not knowing what you're doing or being unable to close a deal, because it will make your journey that much more difficult. Commercial real estate brokers are often the gatekeepers to solid deals, and brokers like to get paid. And since brokers only get paid commissions after a deal is closed, they're going to present deals to the investors that they are confident will be interested in and can close on the investment. So let's get your search started. Finding an investment property. Finding a good deal can often be the most challenging part of this process. Some will say raising capital can be difficult, but in my experience, if you find a good deal, the money will follow. So if you're looking to find an investment property, here are a few different methods you can take. Commercial brokers. Likely your best option since they're doing a combination, if not all of the other methods I will tell you. If you're buying commercial property, their commissions are charged to the seller, so you don't actually have to pay for their services. Networking. Get to know other property owners in the area by networking at industry events or neighborhood meetings. Let them know that you're on the search for commercial investments. You just never know when something will come available. cold calling. Find numbers for the property owners and start calling them asking if they're interested in selling their property. If they aren't at that time, have them keep your number just in case anything changes, and be sure to follow up with them. Mailers. Finding the proper owner can be difficult in commercial real estate since the ownership entities are often hidden. Send letters and postcards to the mailing address on a regular basis. Drive the market. Drive around and knock on doors. I like to look for properties that look uncapped. Those owners may either live out of state or they may not have the funds to keep the property up, which means a buying opportunity for you. Finally, look at as many deals as you can. This step is key. I've seen far too many investors give up before they find a deal. I hear, there aren't any deals in my market, they always say. It's just too hot. I'll always follow those questions up with, how many offers have you made this week? I'm sure you can guess what the reply is. None. You may have to review 100 deals just to find one that will work for you and your criteria. You should be reviewing every deal possible and making offers, even if you feel they're too low. You'll never know what's under that rock if you never turn it over. Step number 5, conduct your due diligence. Once you've found the property and placed it under contract, it's time to conduct your due diligence. As you grow your portfolio of commercial properties, having the right systems in place to thoroughly vet each of your properties prior to your investment will become more and more important. After all, scale can be a double-edged sword if you're buying the wrong properties. So be sure to perform those inspections. First, you'll conduct your physical inspections of the property. When inspecting a property, you may want to tour with your contractor, lender, property manager, and leasing team depending on the condition of the investment. Having the right team together that knows your site criteria will be a lifesaver. After you've built and trust this team, you'll be able to send them out to perform inspections without your having to step foot on site. We have clients that regularly purchase properties sight unseen because they have the right team. Having multiple sets of eyes on the property will also help ensure that you keep oversight to a minimum. You never know what your property manager might miss that your leasing team will catch. In the background, your legal team should be reviewing the title and any other documents given to you by the sellers. Be sure to read through those leases if applicable so that you fully understand what you're purchasing, because as the new property owner, you will be bound by those contracts. Next, put together your asset management plan. Your asset management plan is your investment strategy for that property. This plan will lay out how you plan to perform any renovations, handle the lease up, manage the site, provide financial reports, and more. Think of it as a business plan for your investment. If you have a team working with you, and if you're building a portfolio, you really should, this plan will help you oversee their efforts and keep the project on track. You should have measurable action items for each member on your team based on their responsibilities so that you can easily hold them accountable. When you own multiple assets, chances are good that you won't be able to make it out to each property on a daily, weekly, or even a monthly basis. So these reports are crucial to the project's success. Having already chosen your investment strategy in an earlier step, it's now time to execute. Step number 6, stabilize the asset. At this point, you've closed on the asset and put together your asset management plan. Now, it's time to stabilize the asset. Unless your investment strategy is the purchase of long-term single-tenant deals, chances are good that you'll have to perform at least some sort of work on the property. The quicker you stabilize the asset, the quicker you can move on to acquiring more commercial real estate assets for your portfolio, updating the property through construction and renovation. Having walked through with your contractor, you should have a plan for any construction, renovation, or updates that are needed on the property. If you're taking the development route, you'll have full-blown civil engineering, architectural, and construction plans for a brand new project. Or maybe you're taking the Burr method route and simply need to paint the exterior and replace the flooring. Either way, it's important that you start these updates as quickly as possible after you've closed the property. You will have carry costs starting almost immediately if you take out a commercial loan, which will certainly impact your bottom line. Most commercial tenants may not lease space until it's ready for move-in either, unless you've pre-leased the property or are doing a build-to-suit. So you'll want to get the space prepped for an easy lease-up. These updates will also spark activity on the property, which tends to snowball. So finding and leasing to tenants. If you're planning on scaling your portfolio, you'll want to work with a commercial leasing team right from the start. This leasing team could be the same broker that helped you find the property, or another commercial real estate group simply focused on leasing space. It's also important to work with a commercial real estate broker and not a residential agent. These industries are very different, and you need someone on your side that is knowledgeable about your asset type and your market. Your leasing team will work to find, qualify, and negotiate with prospective tenants on your behalf, which will free you up to focus on your acquisitions. However, if you do choose to lease the property yourself, you'll want to invest in marketing materials such as a website, signage, mailers, photos and videos, floor plans, and more so that you can help prospective tenants make a decision. Then, manage the property. Properly managing your properties is important for many reasons. A good property management plan and team will handle tenant relations, collect rents, collect, manage, and pay all bills, oversee the building maintenance, and provide bookkeeping and financials. Having a good relationship with your current tenants will significantly increase the likelihood that they renew and stay on the property, which will save you a significant amount of money through releasing fees and vacancy loss. Managing the bills is just as important as managing the property to ensure that costs are kept low, but that preventative maintenance is still occurring. Preventative maintenance will save you money in the long run, though it may decrease your cash flow in the short term. Property management is where you will maximize your property's value. After renovations and leasing, how you and your team handle the day-to-day will determine the property's value and can help or hurt you when you look to sell or refinance the project. As you grow a portfolio of real estate investments, you need to be sure that your property management systems can scale with you. You don't want to look at 20 different iterations of financials and rent rolls when reviewing your properties. Finally, step number 7, repeat steps 1 through 6. Once you've nailed down your system for investing in commercial real estate, it's time to repeat it over and over again. You've chosen your asset type, your investment strategy, you've built relationships with lenders, brokers, contractors, and closed your first deal. Commercial real estate really is not rocket science. The beauty of this investment vehicle is that the strategy is easily replicated once you understand what you're doing. Sure, you'll run into minor differences here and there, but the majority of every deal will be the exact same. So get out there and build that empire. That's it for building a portfolio of commercial real estate investments and why you should be doing that. For more commercial real estate investment strategies, leasing and management tips, market updates, and more, be sure to subscribe to the channel and like this video, and I'll see you next time.